Welcome, everybody, to another episode of the Cross Country Super Podcast. And as usual, I'm joined by the lovely Jemma Sanderson over there in Perth. How are you, Jemma? Great to see you.
You too, Darin. Thanks for having me along again to chat and nerd it up a bit about super.
Are we nerding it up? Anyway, obviously, reminding you that this episode is proudly sponsored by Zagga, generating stable fixed income style returns with an investor first approach. Why zig when you can Zagga? And Jemma, we're going to do something a little bit different today. We usually pick a topic and, we have a good discussion about it. But today we're going to actually share some war stories. So we're going to switch around a little bit. Who doesn't like a good war story? That's what they're referred to.
Yep. Love a good
But they're
war
real
story.
life experiences, aren't they? And real life experiences from your point of view as a practitioner. And what could be a better insight into real life examples that will indicate what trustees and members are still coming to terms with or finding a bit of a challenge. So it's going to be across a different couple of topics today, but no doubt it will be fascinating discussion material.
Yeah, always. And a lot of these, so sometimes we get parachuted in to look at this sort of stuff because it needs to be fixed. So sort of dealing with disasters and there's usually a trigger event where that disaster arises. Sometimes the disaster arises right at the get-go because something hasn't been set up correctly, misunderstanding about how the rules work. And then, of course, it plods along for a period of time and someone new picks it up, perhaps a new auditor or change of tax agent or a new financial advisor, and they just go, this isn't looking quite right. What's going on there? So and a lot of this, again, if we're trying to avoid these things from happening, it's one of those things as what's our exit strategy at the get-go. So when we set up the fund and we're adding, mum, dad, and the 4 kids as members, what is that exit strategy if anyone needs to leave? We're buying a commercial property in the fund. What's the exit strategy for when a member dies or you've got other family members in there? And that's sort of like the first example I was going to go through was almost like that. So it was a fund, mum, dad, and 2 kids. So this was before you could have 6 members. You could only have 4, and they had 3 kids. So mum, dad had 3 kids. So one of the kids was excluded from this whole transaction, and that in itself gave rise to a bit of acrimony across the family.
So, as it would. I hope it wasn't the middle child that was left out, because
I think it was.
That would add to the middle child syndrome, wouldn't it?
It was the middle child,
actually. Oh, no.
Yeah. So mum and dad and 2 kids in the fund acquired business real property that the family business was run from, and then one of the kids excluded on the side. And then dad died, and there was properties in the fund that needed to be dealt with as part of all of that. So all of a sudden, you've got a fund with different members in there, and unfortunately the brothers did not get on. There was a big estate dispute happening off on the side. So unfortunately, when that's all happening, the super fund can be almost in limbo because no one wants to do anything until this gets sorted out, because everyone in this particular scenario felt like they had been treated unfairly and that their siblings had got more than them over the course of their lives until dad died, and everyone was out to get more now and be treated unequally. So, from a disaster perspective, it took a long time to deal with all of that. And the other, and you pick these files up and you just shake your head. You're like, oh, individual trustees. So dad died. You had to get, mum and the 2 sons were in there already as the other trustees. Then we had to appoint a 4th trustee on behalf of dad, which was the 3 boys as trustee 4. Now it's got a corporate in there. And then how do we split apart these properties? Because although mum and some of dad's account was able to stay in there for mum, there was a lump sum amount that had to be paid out. And, I trying to figure out what was that. Was that fortunately enough, there was a property asset in there that we were able to transfer to satisfy the bulk of that payout. And then the balance was able to be made in cash. But you can imagine here the situation we have is you've got now mum and two boys in the fund, and the fourth one, well, the third boy still isn't quite in there, but nobody really gets on that well. So then the question asked is, I want to get my benefit out of the fund. How do I do that? And the challenge with that is, so it's like, I want to cut ties with my family and take my entitlements and run effectively. And so that was the reason why we originally got involved. And then, you dig deeper and realize all these things going on. So the first consideration was, well, you've still got your entitlement. So that's not lost to anyone. So that was a big concern. And then the challenge is all that's left in that fund now is a single property that everyone has their member interests are based on that. So in order to roll over someone's entitlement to a fresh fund, they either need to liquidate that property for everyone, but it's being used in the family business, or the third brother needs to roll over his entitlements, his cash perhaps, into the fund to facilitate that. But that's probably not going to be enough. So this is a real challenging consideration, because again, everyone continues to think, oh, well, brother one is getting more and isn't entitled to as much as brother two or brother three, and vice versa. And it's just it's a pretty nasty sort of scenario. And practically, we can't just go, right, well, we'll carve off this part of the property and roll that over into a new fund. Now, you could do that. You'd have to manage the stamp duty on that, but then you're still associated. So you can't just say, okay, well, I'm good, wash my hands and off I go, because you partly own that property with everyone else and, with that super fund. And so you've got that ongoing association and impact. So again, how do you avoid that? And it's pretty challenging to avoid that sort of situation. The wider estate issues really tainted the fund in that situation, but also getting big chunky properties out of super, either on death or divorce, incapacity, any of those, or this dispute, then that's a real challenge. And so an interesting one that's still ongoing, because it is the property used in the family business. So even if middle son could roll over his own super that he's built up externally into the fund, then there's not enough cash in there to roll out the son that wants to leave. So they're still going to always be associated. So how could we have managed this at the start? Well, perhaps not like pitted all the children against each other might have helped from that perspective. And perhaps it was just mum and dad at the get-go, and the kids weren't involved. And look at that. I mean, I do not like having the children in the fund with the parents, because especially if they're younger, at some point, those kids are going to be like, well, I want to, I've got my own family now and my own wealth that I want to be involved in. And that involves adding the spouse to having their own arrangements. And getting people into SMSFs is a piece of, well, it's annoying now because of Superstream, but it's reasonably straightforward. Getting them out is a challenge, because what is their entitlement worth today? Well, I couldn't tell you. The software can't tell you. Could be franking credits owed, all the tax implication, the tax treatment of distributions and all that sort of thing. So there's always leftovers that need to be dealt with. Anyway, that was a good fun one, Darin.
Well, it sounds like a real mess, Jemma, and it raises so many issues as well. I mean, number one, obviously, how wise a decision is it to include your children in the fund? I mean, that's got to be first and foremost. Number two, what you emphasized is that you always have to have the end in mind when you're at the beginning, try, and nobody can obviously predict what is going to happen.
Mm.
But if you can obviously plan for as many of those contingencies as you possibly could foresee, that would be a prudent thing to do. And of course, we've discussed this on several occasions, maybe even in the last podcast when we talked about properties. You know, when you've got lumpy assets in your fund and you've got members who are maybe at well, their motors are not on the same page,
Yeah.
then that becomes an issue because it's not a liquid asset. In order for people to break away, you have to liquefy. You just about have to liquefy that asset because, I mean, if you're talking about a property, who's got just some lazy cash lying
Yeah,
around
exactly.
where you can just, as you say, implement that strategy where, oh, I can just tip in some cash, get my share, and that's it. Who's got lazy cash to do that? Particularly if, I mean, I don't know how wealthy people's children are, but you'd think that they're probably early to middle aged, and
Yeah, that's right.
in most cases they wouldn't have built up a wealth balance which you could just easily flick a switch and say, oh yeah, I've got enough cash. And of course, on top of all of this, if you're talking about a situation where a person has died, I mean, that in itself is a fairly traumatic emotional
Yep,
experience.
definitely.
So, how people are even going to be thinking rationally to try and nut through these issues in that scenario, and you throw on top of all that family grievances,
Yeah, that's
like
100%.
how do you navigate your way through that? And you've got horrendous stories. I remember David Saul was talking to me a while ago about from Saul's auditing. He was talking to me about a dispute like this where brother and sister couldn't get on. I think it was brother and sister, and they fought so hard that pretty much all of the super fund money was eroded.
Oh, with legal fees?
Yeah.
Yeah, right.
They couldn't find any middle ground, and or I don't know whether or not it was all, but a substantial part of the superannuation fund's assets were eroded away simply because it was funding the dispute from either side
Oh, that's
to
nasty, isn't it?
try and get their hands on the money. But well, 0% of zero is or
Still zero.
50% of zero is zero.
Yeah.
So I mean, so many issues to unpack there. Boy, does it pay to put in place a strategy to, as I said, you can't predict everything, but just try and mitigate some
Mm.
of these things. Obviously, the law change might help this a little bit now that you can have 6 members in an SMSF. Middle child doesn't have to be excluded anymore, which is well, we can tick that box off. Whether or not that would have improved any of these sibling rivalries
I
or
actually think that the
contests.
middle child actively didn't want to be involved at the time.
Oh,
Now,
well,
on
that's
reflection,
different then. Then he
but
can't.
now it's, that was when the properties were acquired. That was
Yeah,
20 odd years ago.
yeah,
So, and with the end in mind, mum and dad were probably in their 60s then. They weren't even thinking of what happens when one of us dies, all of that sort of thing, because totally different rules. So
yeah.
it's one of those things where if we're assessing, so what was fine previously, where you could keep all the assets in the fund, even children could be child recipients, regardless of them needing to be disabled or a financial dependent. You had totally different rules that applied back then. And so, it's really interesting when you assess this and you're chatting to clients, and particularly, the Division 296 provisions are a good prompt for some of these conversations. You've got a really lumpy asset in there. You're going to be having to pay Division 296 tax, and therefore, on the basis that that actually passes through, and therefore these are the implications. Is there enough cash flow in there? And actually, now it's just mum. What happens when mum dies? Mum's account is 2/3 of the fund, so that property is going to have to come out of super. Uh, in the main, what is that going to look like for the kids? What other strategies can come through from that perspective? And anyway, it keeps us all in a job and B interested, because it is quite interesting work to navigate through what all the options are, how we can manage it, how we can deal with it, and the family dynamics. I've sometimes I wish I had a psychology degree, because a lot of what you're doing is managing how that all looks. You put your Dr. Phil hat on and try and have those conversations. Anyway, that was a good testing one to start with from that
Well, it's
perspective.
so difficult, and again, it highlights the fact that you're talking about something that was put in place over 20 years ago.
Mm,
And we talk about this all the time. I write about this all the time. You mentioned Division 296 tax. There are so many legislative changes going through on a yearly, monthly basis. The landscape is changing so often that, again, it highlights the fact that any strategy that you put in place with an SMSF, it can't be set and forget.
yes,
It just
absolutely.
simply can't be set and forget, because not that I want this, and I don't think any of us want this, but the parameters of the goalpost just continue to change all the time. I mean, simply enough, you can, even though the middle child in this situation didn't want anything to do with the superannuation fund, but at least right now they would have that option of including that child.
Mm.
Back then, they actually didn't. You had to make the choice of, okay, so which
Which one's the favourite?
which one do we leave out?
Yeah.
I mean, that in itself, even if he did volunteer to be left out of it, for parents that would be a difficult choice to make, wouldn't it? That would be a tough one. They don't necessarily want to favour one child over another.
Mm. And then that
That's
also leads to this consideration, this wider, that we can't have our blinkers on. Often, super, from an estate planning perspective, super is a substantial asset. And my experience is that there's a lot of misunderstandings about how it needs to be dealt with and all those sorts of things.
yeah,
So in this situation, there was the super and you had two of the sons in the fund. So they benefited from that fund. The third son had his super outside. But at the time, 20 odd years ago, whether there was a situation that, okay, well, we can only have two of you in there, we'll plonk these two, you two are the ones, and you're getting a share of this property, and that's how that's going to build. So whether they equalize that with the third son outside, what that looks, because then you've got in super versus outside super,
yeah,
and
yeah,
then, oh well, he was perfectly well looked after,
yeah,
because he got an amount outside super, but he might be thinking, well, hang on, maybe I did, but it was not in super, so a different tax outcome, so I'm worse off because of this. So all of those dynamics come through, and it's the family dynamics on death, the certainty. It's very helpful to have that certainty in there, and the transfer balance cap has thrown the any of those big chunky assets is a real concern when a member of a couple dies as well, because does an amount have to come out of super? How much can you keep in pension phase for the survivor? All of those sorts of things. So it's an interesting, again, like I said, keeps us all in a job and interested, because things keep changing and evolving, with the tax office's interpretation of things, rulings here, a case over here that has a different interpretation. It's definitely not set and forget at all.
yeah. No, that's a great war story to kick us off on today. So many issues addressed there, and I didn't even talk about corporate versus individual trustee.
Yeah,
But that's
yeah,
that's another one that you touched on, whereby regardless of the family feud that we're talking about here, but just the death of a member in a four-member fund, individual trustees,
yeah.
person
Mm-hmm.
dies, transfer asset holding to the different names again. What a mess that is.
Yeah, it was quite a mess, and it was a property that was transferred from outside super into super back in so it was 2007, when the $1 million non-concessional or undeducted contribution limit was available.
Yeah.
So that's what happened, and from a So in WA, this was from a transfer or stamp duty perspective, it was done in quite odd proportions. And then anyway, so the way that that's been managed ever since has been, the stamp duty implications of that. You can change the trustee, that's all fine, but the way that the original trustee and the proportion of ownerships was set up was all a bit quirky and odd and unnecessary as well. So, again, what was done under rules in 2007 no longer applies. And we've since had, well, in WA, my reference point, we had a new Duties Act that came into place in 2008. So, all these things constantly evolve, and it's a challenging conversation to have with people when they've got individual trustees, and you say, look, it's worthwhile if you change it to a corporate, because when one of you dies or becomes incapacitated, you're going to have to add another person or change it to a corporate then anyway. So you're better off doing it now whilst everyone is on board with getting it done. But people don't like the cost. Now, it's not what costs the most is time to update all the asset registrations and all that sort of thing. Now, depending if there's properties in there and you're having to, you'd want to watch out for stamp duty depending on which state you're talking about. But that's generally far better to go through that exercise when everyone is on board, has capacity, and no one's died yet, than having to deal with it when someone's died and they can't sign anything anymore. And then you've got who are the executors, is probate being granted, all of that flow on side of it. So yeah, it's that one little thing of, can I roll my super? I want to roll my super out of my parents' fund into a new one and cut ties with my family super, then just went with all sorts of other things going on.
I think it's classic, Gemma, and I hear this from a lot of practitioners out there. And thankfully, the tide is starting to turn where the corporate trustee is the more favoured structure now,
Yep.
as opposed to the individuals. But I find it fascinating that a lot of the time the argument against is, oh no, but a corporate trustee costs more to do, right? It's a bit of a cost factor. I'm not really that comfortable with it. Well, if you're talking about thinking about the end at the start, how much money do you reckon it's going to cost you to have to transfer those assets into the other individual trustees' names if one member dies, or then switch across to the corporate trustee at that time? Surely that, well, if nothing else, with legal fees and whatever that you need to pay in order to facilitate that, that's going to cost you heaps more money at that point in time than just doing it right now. So I always find that argument funny.
Also, the other thing with that is, I don't want to pay for a corporate trustee as part of the setup. Well, then a self-managed fund is not for you, because if you're that hyper cost conscious, is that because what you've got in super to put into a self-managed is not really enough to make it, economically feasible? So that's another conversation to be had when people push against that. And I have had clients where they had 4 members in their fund, individual trustees, and then one of the kids rolled out and they brought in another one. And at that, they wouldn't even entertain a corporate trustee then. They said, no, it's fine. We'll just change the registrations from 4 to, they were happy to, and I just was dumbfounded. But, again, everyone has their own views on life. And yeah, I'm completely dumbfounded when it's a cost. Like that's the biggest pushback is, oh, it costs so much more money, because it doesn't.
Oh, you're so right, Gemma. I mean, that's got to be a red flag to start with. I mean, to prompt the question, do you actually know what's involved with running a self-managed super fund? And I would argue too, if someone has to go through that exercise of one trustee going and another individual trustee coming in, okay, I could say to you that, oh, it's all right, Gemma. Yeah, we're cool with that. It's okay. But do you want to do that 4 times, or however many times that you're probably faced with, if another trustee dies, God forbid, dies, or
rolls over,
or doesn't want to be part of the SMSF because obviously people's lifestyles and circumstances change. Do you want to go through that, not just this one time, but numerous times to try and find a solution? That, I
To
mean, to
save
me,
a few
that just doesn't,
$100s.
exactly, that just
Yeah.
doesn't seem to make sense. But,
What has helped
I
a little bit is the trustee penalty or the admin penalty regime,
oh, yeah.
because it's per trustee.
Yes.
So if you've got 4 or 6, sorry, I can't handle that potential consideration, and a penalty is imposed, that those are outrageous amounts that could come through. 60 penalty units per trustee times 6, because there's 6 of them. That just would make you sick. So there's another good reason to put in place a corporate.
Well, I'm assuming inaction on that front would be the attitude of, well, that's never going to happen to me.
No, because I'm doing everything correctly.
Correct.
Yeah. Yep.
Of course.
And my another scenario that sort of plays a little bit on the death of a member is, so that was death of a member with a dispute amongst the family with children in there. Another one that we're dealing with is death of a member, and because it was a lumpy property that was in there, when they divorced, they both stayed in the fund to maintain because of that lumpy property.
Yep.
And now one of them has died, and the survivor of, I mean, they're divorced, but the survivor in the fund, the surviving member, wants to retain the property, but doesn't have enough benefits to do so, because the issue with that is they're not going to receive the deceased benefits because they're divorced. That's
Yeah,
going
right.
to the new spouse, and there's a dispute happening outside there as well. And so we're looking at the strategies there of how do we try and engineer this so that the surviving member can retain all of that property within the fund. And that's a bit of a challenge in itself, but there's some stamp duty things we need to be aware of, and various bits and pieces, but we're working on that. But again, that whole, what was the exit strategy, even if you didn't contemplate divorce at the time of putting the property in there, if someone died, then how would that be sorted out? Now, if one of them had died and they were still together, the opportunity there is for the survivor can keep up to their transfer balance cap of the deceased account. So that does help. But then what happens when they die? And that's really where these sorts of things are coming through. This, if they end up being the only member of the fund, then that just has to be paid out. That's actually easier than if my other scenario where you've got 3 members sitting in there. If mum dies, again, you're cutting up a property. What does that look like? Those big chunky properties in funds is a real challenge.
And of course, no one wants to contemplate the scenario of death, do they?
No,
I mean, it's not the most cheerful subject or the most pleasant subject to have to talk about.
absolutely. But you've got to bring it up, and you've got to have those conversations with people, because so a lot of sometimes the head is in the sand because they don't want to deal with it, but also they don't want the family to have to deal with any issues. So it's
Yeah.
really contradictory. It's like, oh, I don't want to deal with it, but I don't want the family to. So that is actually what gets them over the line to have the conversation and chat about it. And then, but then the challenge with that is, okay, these are the issues and risks. If something happens to you, this is what will happen within the fund. This is how it works, etc. Those tax implications of death benefit payments out to non-dependent adult children, all of those sorts of fun things. And again, it's a bit of a grim conversation to be having, but you're better off having it now when the person has capacity and they've got the opportunity to make those decisions that can then, they're making it on behalf of their family for the best thing for their family, if that's what their concern is. So it's it's unfortunately, death and taxes. And as we look at, and I'm so good, we're very good at digressing, aren't we, Darin? You look at the stats that came out about or the expected stats on Div 296, which was 80,000 people will be
Yes.
impacted by this.
Yes.
And something like 85% of them are over 65. So we've got a large amount of wealth. If you're thinking that cohort of balances, a large
Yes.
amount of wealth that is over 65. And so that transition that of, that intergenerational wealth transfer is happening already, and it's going to accelerate a little bit. And so all of these super funds that have got really chunky properties in them, they're some of the really big concerns there, that's going to have to, and Div 296 tax overlaid with that. If you're, is that a prompt to, okay, let's assess the investment strategy. Is super still the right place to hold that property that's in the family business when I want it to go to Timmy and Jimmy and not Kimmy when I die? So do you bring forward those estate planning conversations to now and sort of say, okay, in light of this, and this happening, Mum and I are in our 70s, this is how we want to deal with it, all of those considerations. So it's a good prompt to have those discussions, and like you said, it's not a set and forget.
Yeah, 100%. Well, let's move on to one of your other war stories you'd like to introduce, Jemma. Fascinating stuff, the first one. Can we rival that? I mean, that's crossed so many issues, really.
So we can certainly rival it. With a bit of a sidestep, and again, we get involved in some curly matters, and often when we get parachuted in, it's to deal with a disaster, for want of a better phrase. So we've had a few recently where we've got unit trust investments in the super fund, and the expectation at the time is either that it's a unit trust exempt from the in-house assets test because it's satisfying the requirements in SIS regulation 13.22C, or it's an unrelated unit trust, so therefore it doesn't meet the definition of being a related party under section 71(1). So we had two of these happening, and I'll go through the first one, which was the movement of some properties from mum and dad into a unit trust that was owned partially by, so this is where this isn't bad planning at the get-go. 3 sons, so lots of boys here. 3 sons, they're separate super funds, so it wasn't everyone lumped into one fund. So 3 separate super funds, also they're 3 discretionary trusts, and a unit trust was set up sort of, call it in the middle, where each son ended up with a third entitlement, partly in their super fund and partly in a trust that they had. So, and that all depended on the ability for the amounts to contribute to super. So one of the sons was able to put in $540,000 for himself and his spouse. So they had $1 million worth of entitlement to this unit trust, and then the rest of their third was in their discretionary trust. So all unequal proportions. So you can imagine that accounting nightmare. Anyway, when that all happened, it all sounded good in theory. It did tick the boxes in concept, but in execution, it did not. So what happened was, instead of those being the acquisition of units into the trust to then acquire the properties, 4 properties was part of all of this. Then instead of it being the subscription for units, so fully capitalized, no loans, the initial injections of capital were treated as loans from all of the unit holders. So straight away, we're not exempt from the in-house assets test. And we've got a 13.22D situation, and then you can't just fix it and then be exempt from or fall under 13.22C anymore. You're no longer exempt from the in-house assets test, and you can't fix it. So then it was a matter of looking at, okay, right, well, that happened basically on inception, which was quite a while ago. So not 2007. I think, from testing my memory here, it's probably about 5 or 6 years ago. But it was plodding along without any sort of issue until the auditor changed. And then the auditor was like, oh goodness, what's happened here? And then sort of got us involved. What was also interesting was that because each of the kids had a third each, effectively. So, but they're all in unequal portion. So it wasn't like each entity had a sixth each.
Yeah. Yeah.
But all of the distributions were treated as if it was a sixth. So that's how it was. The distributions were treated through the financials, but the cash actually all went to the super funds. So we had all these other, fun adjustments and things like that that needed to happen. So clearly we've got an in-house asset. Conveniently, and the timing of rectifying that was beyond the time frame that under the legislation, the 12 months, etc. But what we were looking at doing is, okay, how do we fix this? We fix it by transferring. We need to get rid of this unit trust, so we can vest the properties up to the unit holders and make any other adjustments as required. So each of the super funds will end up with a proportionate interest in 4 different properties. So that's all a bit of a, when you think about it, an interesting scenario. But we do have some breaches historically there. So it's one of those things where, real challenge coming through. And yeah, our implementation. So the way that this, when you're implementing these things, our preference is to fix it, and then when it goes to the auditor, they will lodge their auditor contravention reports and say, yep, breach of in-house assets test. This is a breach. This is a breach. And, it's obviously very transparent, and they're doing all the right disclosures and lodging all the ACRs. And then for the tax office to look at it, because by the time that's happened, it's all been fixed, then even though the ACRs have been lodged, because the breaches have been rectified, then our sort of cross the fingers hope is that when the tax office picks that up and goes, oh, whoops, what's happened here? Well, those are breaches here, here, and here. Oh, it's all been fixed. We might get a call or a letter from the commissioner saying, okay, you've breached these provisions. It says it's fixed. Show us how you did it. And then, we provide all of that information. And then it might be, right, well, this is not great. Maybe the trustees need to go and undertake one of those education courses or the like. Or the tax office may well launch an audit, which I'm yet to see, to be honest, where that situation occurs. Our experience is when we can fix everything and we do it properly, and then when the auditor lodges the contravention reports, all of the breaches are rectified, then mostly the tax office will, respond and say, yeah, we've noticed this, this, and this. We're keeping an eye on you now. We've got you in our sights a little bit, but, we'll allow it. It's a foul, but we will, play on, sort of thing. And so far that's been the outcome. And because we just want to avoid obviously an audit or the follow on from that, which might be disqualification or non-complying funds and the like.
Yeah, great advertisement for self-rectification.
Yeah.
I know that the ATO always bangs on this, that look, if you take proactive steps to any of the mistakes or any of the compliance issues that your fund might have, we will look favourably upon that if you can provide the documentation and the evidence that you've recognised it, you've put a plan in place to try and fix it, and at the time of communicating to us, that's either been completed or it's well on the way to being completed. So there can never be a scenario where you just throw your hands up in the air and think that, well, that's too hard, and maybe if we don't tell them, it will
It'll go
away.
through to the keeper.
But obviously you can't, because there will always be a trigger point. In this case, it was the appointment of a new auditor. And often that is when mistakes are picked up, when a service provider ends their service and a new one takes it on, be it an administrator or an auditor or anybody like that, even an advisor, accountant. They're reviewing something with a completely fresh set of
eyes. Yeah,
and
100%.
then it could be like, oh, hang on, who told you this was okay? And I do wonder in that situation whether or not they just got a little bit of poor advice or unspecialized advice in the first place, because seriously, the treatment of the monies invested in the unit trust as a loan immediately renders that whole strategy
Yeah.
completely void, doesn't it?
That
And
absolutely
that's from the get-go.
from the get-go. Yep.
That's not like, oh, we didn't
An
know because this
inadvertent
happened a little
like
bit
slip
later.
up later.
Yeah,
100%.
yeah.
Yep, that's right.
That's just like, so to me, that indicates that, well, whoever gave you the advice didn't actually understand exactly how that regulation works. And
So the advice
it should have.
itself was okay. It was the execution of it that was poor,
Yeah,
because it, instead of them being treated as the subscription for units, it was treated as loans. And then, like exactly what you said, that just taints it from the get-go. And the other, this was, and I think this is another advertisement for auditor independence. So this was a situation where, since that arrangement was put in place, it wasn't there. It got a clean bill of health from an audit perspective all the way through to the tax office, because the tax agent and the auditor were the same.
yeah.
And
Well,
so they were unaware of this requirement and what the rules were. And so it was just, yep, it's fine, it's fine. And then when so it was a change of tax agent and auditor, it was again going, oh goodness, what's going on here? Right, let's delve deep. What happened? How did it work? What's occurred? How do we fix it? And then putting in place the steps in order to do so. But it's not a cheap exercise to undertake, because obviously, we've got to get involved, well, us in this situation, but, someone, whether it's the new tax agent, needs to get involved to try and figure out, A, what's happened, and then B, how do I fix it?
yeah.
And then maybe you need to get specialist lawyers involved from a stamp duty perspective and drafting transfers of land. And, it's a reasonable exercise just to and calculate. Like I said, we had uneven proportions, but distributions in the accounts a sixth each, but cash a third only each to the super funds. So, it was all that fun stuff. So again, it's very interesting things to look at, and it is very satisfying when you get the opportunity to have found a solution and being able to execute that solution without, too many adverse subsequent implications as well. So, a lot of these I'll call them disasters, but a lot of these breaches and compliance considerations, they can be sorted out. It's when the head gets buried in the sand, and just, we'll go through to the keeper, it'll go through to the keeper. That's when, that's a challenge. And then back to the previous comment about, oh well, our fund is clean as a whistle. It's we don't need a corporate trustee for those admin penalties. Yeah, you wouldn't want to be in that situation. If it went, that could trigger an audit. And then
Yeah.
all of a sudden, every breach of the in-house asset provisions, ping, 60 penalty units per trustee, ping, ping. So yeah, you absolutely do not want that situation. And maybe again, we're tainted because we deal with some of the more complicated ones that do have these issues. No doubt, on most people's tax agent lists for their super funds, they might have one that has a challenge in it, and the rest of them are vanilla and just plod along perfectly fine. We just have a higher proportion of those challenging ones to look at. But again, like, I love that stuff. Like I said, nerding it up. It's it's really interesting.
It does actually highlight. I know that a lot of people find this a bit of a nuisance, but it really is an integrity measure of the importance of auditor independence,
Yep.
because, as much as you'd like to try and convince me that the Chinese walls work and we work on the floor above and they work on the floor below, and there's definite separation here. Look, at the end of the day, I don't think anybody could argue that there isn't a hint of conflict of interest there.
Yeah.
And of course, we do run commercial enterprises. All of us run commercial enterprises. We don't just do it for the love of, the love of the sport, so to speak. So if you are perpetuating that situation because obviously you're getting more fees for your organization, you're going to do that. But it's not necessarily in the best interest, because, and I'm not criticizing this, because self-interest is one of the best motivators for anybody to do
Yeah.
anything. But, it is prudent to have somebody look over the top and say, hey, listen, look, the conflict is too much there. And again, Chinese walls as much as you like, but I'm not going to say that they don't all work, but
Well,
you
it's
can't
also
say they're
just
not.
prudent
Well,
risk management and
yeah, they're
quality
questionable.
assurance,
Yeah.
like a bit of peer review. Because, and you made the point earlier, there's so many items of superannuation that are changing on a daily basis. It's a new ruling, it's draft legislation, it's a press release about something, it's proposed this, it's the implementation requirements or the tax office procedures has changed on that. There's a case that comes through. So it's constantly changing. And so trying to keep on top of that CPD is why, we're talking about these sorts of things, why there's
Yeah.
a podcast, why there's ongoing conferences, why there's always seminars and webinars. And, to be perfectly honest, you can't be on top of everything. It's just not possible
No.
unless you spend your whole day actually reading articles, reading cases, and all that sort of thing. But then you don't have any client work to pay the bills. So, it's you can't possibly know everything. So that's
No.
why that it's so vital that you do have the auditor to just go, oh, Jemma, were you aware of this in-house asset rule here? Oh, no, I didn't know that. Oh, geez, better sort that out. And from that perspective, so it's just a prudent thing to look at. And again, if you've got a tax agent registration or you're a member of one of the professional bodies, that's your responsibility to
Yeah.
be undertaking all of these and making sure that your risk management is covered off on
Yeah.
from that perspective.
Yeah. So who would have thought? Big green tick to Apes 110 from us.
Yeah, yeah. But I think that it definitely is. And I know that comments have been made again. I'll digress. Comments have been made in the press. People saying, "Oh, you should change your auditor every 5 years, just so that you get a fresh set of eyes." Now, I don't think that that's necessary because between the tax agent and the auditor, most the combinations of that being separate businesses, you'll have different people that are touching the file and will pick up on new things. So it's I don't think that that's necessary. And also changing changing like service providers, it's not a straightforward consideration anymore. So if the requirement was, well, every 5 years you've got to change your auditor, you've got to change your tax agent. To change your tax agent, you've got to do that all through client agent linking through the tax office. That's been a bit of a disaster. And I know, again, I digress. So it's having that that sort of that peer review and an independent audit, I think is just massively ticks the boxes. And super, the tax concessions there are unbelievable. And so it's again that being that integrity measure, I don't think it's too much to ask for.
No, I think suggestions like changing your auditor on a regular basis, be it 5 years, and of course, if you propose 5 years, someone's going to propose 4 years, someone's going to propose 3 years, someone's going to propose 2 years, and then someone's going to propose you got to get a new one every
Every
year.
year, yeah.
That is way over the top because while you're talking about integrity measures, I don't think you can underestimate either or lose sight of the fact that you've got to do the right thing by this self-managed super fund itself.
Mm.
When you don't want to be imposing um, a ridiculous administrative burden, an additional administrative burden on them by implementing a measure which is potentially way over the top of what you're trying to outlaw. And that, of
Yes,
course, in
yeah,
itself will be counterproductive because not only will it not happen, people will just say, well, I'm not going to. I mean, we talked about, well, I don't want a corporate trustee because it costs too much. There's going to be this, well, I'm not going to change my auditor. I mean, do you know how much it cost me last time? I bloody will change something like
yeah,
this. I'm
yeah.
not going to do that. In which case, then the whole process falls over.
Yeah. Do you remember when there was a proposal for the three-year audit
Yes,
period?
yes.
Can you imagine if that was that was awful? That got knocked on its head pretty quick though, thankfully. So
Yeah,
no.
Stuart
Mm,
Robert, not his best moment, but then I think he's had very few best moments when he was looking after the portfolio, but seemed to be quite blinkered in wanting to bring that one on. And yeah, again, you talk about, I mean, these war stories we're talking about, when was the compliance situation picked up and whatever. I mean, what happened if it was another 3 years down the track
yeah.
before anything happened? Then all of a sudden you've got additional years to try and unwind, additional years to try and prove to the ATO, look, we've picked this up, we're doing this, blah, blah. And of course, then if the ATO is wanting to see some material evidence that, oh, okay, so we can see what you've done here and the effect it's having and it's near completion or whatever, that's going to make that process so much
So
more
much,
difficult.
yeah. And it's and
Um,
even the way that obviously our lodgement programs work. So with if you've got a tax agent, you're due for lodgement in May of the following year, if not June. So sometimes you're chatting to clients and it might be April or March. You finally got those tax statements through from their investments or whatever that looks like. And then so we'd be doing the 23-24 financial statements and it's say March 2025.
yeah.
And you're talking to the client, you're saying, oh, so Darin, what was this transaction that happened in July 2023? And you'll be like, I don't know. I can't remember that far back. It was probably this or probably that. Or, so it's that the way it currently works is, already you can be dealing with stuff 18 months prior that you're trying to get to the bottom of. If that was, and I mean, the annual statements, financial statements would have still been yearly in the tax returns, but that
Yeah.
audit cycle, 100%. If you were saying, oh, right, so May 25, Jemma, what was this transaction that happened I'm auditing 24. So that's from the period of time, maybe 2020, 2021. What happened there? And you'd be like, oh, that was COVID. Like,
Oh,
does
yeah.
anyone remember what happened
Yeah.
during COVID? No, no one remembers any of that. And, it's challenging me to get bank statements that far back online, all of those fun things. So,
Yeah.
anyway,
Yeah. Well, I
just
can't
a
even
little bit of a
remember
rant there. We
I
always
can't
love a
remember
good
what I had
rant.
for dinner last night, Gemma. So thinking back to a few years of what you did, that's a pretty tough ask. Well,
Yeah, absolutely.
we've probably got time for one more.
One
These are
more. Okay.
fascinating.
It is. Oh, see, we love a good war story. So another one is an in-house asset consideration as well. So you've got the in-house asset rules where the whole family wants to own 100% of the asset, and it goes into a 13.22C unit trust. As long as those requirements are met, then happy days. Go forward. Now they're quite strict. So if you read 13.22D, in the scenario I just went through, one of the big issues there was loans. So
Yeah.
if that had been undertaken correctly, then that would have been fine. But anyway, so that just dealt with it at that point. Now, that's if it is an in-house asset, as in it's a related party of the fund, because you have a look at the 70A through to 70E of the SIS Act, and it goes through what a related party is, Part 8 associates, all that fun stuff, right? Now, those provisions only apply if it is a related party. So 71(1) has a 5% limit on an in-house asset. So an asset or an investment in a related party. So what some people do, so say you and I, we're like, right, well, we're not related. Let's invest in a property together using our super. And if we do it via a unit trust where we're 50-50 straight down the line, no one owns more than the other, we're not controlling any more than the other, awesome, let's do it. So you set up a unit trust, money goes in. That trust, because it's not an in-house asset, can borrow. So it might go off and borrow. You inject in 250 each, let's call it. It borrows 500. So $1 million asset gets bought with 50% LVR. But, tick, 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 because it's not a related party. It's not an in-house asset. You're not limited to 5%. Now, what often happens, so you and I, we know each other, but we're not related at all under any of those provisions. But there's certain elements in those provisions that people don't look at properly. And in this particular scenario, one of them was partners in a partnership. So in situations where, and this one was an actual partnership to do with some farming property or some farming enterprise. So it would be like you and I were in a partnership, and therefore all of a sudden that is you and I are related, we're Part 8 associates. So that unit trust is not an in-house asset. It is an in-house asset. So all of a sudden, that's in breach of the 5%. And upfront, how was that set up? Now, usually in those situations, the subscription for units is like $1. So at the acquisition time, it's not an overly huge amount. But if you acquire more units, then that starts to be in breach of the 82.5, or where you can't acquire an in-house asset if it will push you over. And so instead of just looking at, 71.1 says you've got 12 months to deal with it and dispose of the offending in-house asset to come down below the 5%. That's if it becomes an in-house asset after it's been acquired. But if it was an in-house asset at the get-go, then you can't acquire that asset for if it will push you over the 5%. So that was one, and it's we're still like dealing with the best way to rectify it, because there's now a couple of properties in there, multiple loans, and a dispute between Jemma and Darin are having a fight. So so we won't really talk to each other. No one wants to deal with it. And so that's the other consideration with all of this. So again, very interesting to see how that will progress, but highlights again the importance of getting the structure right at the get-go. It's like self-managed funds, and I'm not biased at all because I love them. That people think, really, really awful investment restrictions. Well, if you're aware of how they work, there's a lot that you can do in a self-managed fund. You just need to know how all those investment provisions operate. So it's like there's so many opportunities there, but you've just got to get it right at the outset. If back to that, what's the exit strategy? Well, you hope the exit strategy isn't dealing with a disaster. You hope that the exit strategy is, it's all fine, and we sell the asset and you make your money and you move on, type thing. But you've just, particularly when you're looking at unit trusts, investments, big, chunky, lumpy assets, it's really important to be aware of how that flows through, what the ongoing obligations are. If you're leasing the property, you've got a related party lease, is it ticking all those boxes? Are the regular payments there? Like all of those things, it's checklist, checkbox ticking. And if you can do that, and it all works, they're fantastic opportunities within self-managed funds. But there's certainly, and it's the smallest things, like my first scenario was probably the doozy, but my third one wasn't too bad in terms of the execution of the initial investment to then acquire these properties was done incorrectly, and then it just tainted everything. So getting that sort of stuff important. And when you overlay things like the non-arm's length income and non-arm's length expense provisions now, that little element, you just don't want the slightest thing to tip you over. So it's just getting the advice, making sure that all the I's are dotted and T's are crossed, and then and it's not set and forget, and things can tick over quite nicely as long as you get it right at the get-go.
Yeah, and of course, in-house assets and related party transactions is a bit of a minefield as well, and it needs to be taken with a lot of care, because the scenario that you just pointed out, I mean, that's a fairly obvious one, that if we went in it, we were in it together, but we were actually business partners with the farm equipment and whatever. That's a fairly straightforward, well, it's pretty obvious that you
Well,
guys
we
are
think
related
so, but
parties.
we're in this every day, and
Of course, but it can become even more obscure than that and more far-reaching. So I mean, as I said, in the scheme of things, that's probably an easier one, but there are so many minefields out there and little traps that can just trip you over.
Yep.
Something that you would be completely oblivious to or completely inadvertent to the fact
Yes,
that you've
100%.
actually breached these rules.
And I think that that's like my example where I think it was my third example with the multiple properties and the loans that correct classification. So, the tax office, they're not monsters. They're alive to the fact that there are inadvertent mistakes that are made. And again, my experience is if you detect the mistake, fix it, and then you're still transparent to say, yes, there was an error, there was a breach, here's the ACR, but it's now been rectified, then generally they're pretty accommodating and they say, yep, take that on board, can see it's been fixed, actually give us a bit more information, or it was a minor breach. And a lot of these breaches are minor. It's things like the bank account set up in the wrong name because it was set up in mum and dad's own name as trustee for the fund when it was a corporate set up correctly at the get-go. And then, that's a breach of I think it's regulation 8.02 or something like that. So that, it's a breach. So it gets reported, but it gets fixed. It's a minor breach. The resources of the tax office aren't really there for that sort of thing. And it's the, you don't want to be the one that it's gone on for 5 years and then they detect it. And then, you've got that audit coming through, you get targeted for an audit. So it's, if an error is picked up, then you can always, generally, I've only been involved in a couple of times where we've had, look, disqualification is on the counter. And, in both times we were able to get it withdrawn. But one of them was, well, you've got to wind up the fund and move the money out. And that was like, yep, they don't want anything to do with it anymore. And that was another fun one, which was a unit trust set up where it was, again, it would be like Jemma and Darin setting up a unit trust to buy a property. But instead of it only being Darin and Jemma as the directors and the shareholders, it was Darin and Gemma's husband, Jeff, that were the three directors. Boom. Then it's an in-house asset of my fund and you're out, basically. So, it's, again, that was completely inadvertent. Well, we'll just, who's the directors are, doesn't matter. Just throw everybody in there. And yeah, so that was the challenge from that perspective.
Yeah, and I must echo your sentiments about the ATO as a regulator of the SMSF sector. They do seem to be very, very reasonable as far as their approach to compliance goes. Certainly, the anecdotal evidence that I've heard does suggest that, and they stick to what they tell you. That
yes, they do.
They encourage you to use the avenues available to you to self-report and to also interact with the ATO proactively so that you can get on top of these issues. And if you do that, they'll be reasonable in their response to what you've done. So I think, while there can be always a perception that the ATO is this behemoth out there that you just don't want to be crushed by, as far as a regulator for this sector goes, I think that they're reasonable and very, very measured in their approach.
Yep, 100%. I would agree. Yep.
Well, Jemma, we've nerded up for over an hour now. We're just on an hour now, so we've run out of time. And I didn't even fit in a Star Wars reference or a Simpsons reference today. So I've completely failed in my mission.
You have failed, as have I, because that's also on my list of things to try and accomplish during one of our podcasts.
So hopefully in the next episode, we do a better job at trying to fit in those pop culture references that we love doing.
Yep.
But apart from that, as I said, we've run out of time. So thank you again, Jemma, for joining me on this podcast and your infinite wisdom and for sharing those fascinating war stories with us that obviously have covered a multitude of issues to do with SMSFs today.
My pleasure, Darin. As always, I love having these, chats and just talking about all the nerdy things. It's it's interesting.
Great. Look, thank you to my team for putting these podcasts together. They do an incredible job behind the scenes. I know you can't see any of the work they put in behind the scenes, but I think you'd all agree that that the finished product is usually pretty good. So thank you very much for that. Thank you also to Zaga, our sponsor for this episode. We really appreciate your support and the support you've given us across many of these podcasts so far. But most importantly, thank you to our audience out there for joining us and listening to us nerd it up for a good period of time. As usual, we hope you found this a little bit informative and as interesting as we find discussing these issues. And don't forget, if you are enjoying our content on YouTube, please smash that like button and remember to subscribe to the channel. Other than that, again, thank you, Jemma. Look forward to seeing you for the next episode and look forward to all of you joining us for the next episode of the Cross Country Super Podcasts. Have a great day. Bye for now.